Is Wells Fargo teetering on the edge of a financial crisis? Is the consumer price index about to rocket higher? And why are speculators back shorting bonds? Answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and as you can see, we're hanging out just outside the moat of the castle because we're building a big moat around this 2% level, keeping those speculators at bay. They don't realize what's going on, but of course I want to thank the fan who sent this in. Thank you very much. So let's get on to this topic of what the heck is going on with Wells Fargo. Now, you probably heard a lot of other people talking about how Wells Fargo has cut their personal credit lines, and that is an indication of a major problem with Wells Fargo. There's problems in the banking industry. Perhaps this is an indication of a liquidity crisis or a financial crisis. And well, today, I'm going to give you the truth about what's really going on with Wells Fargo. For those of you who missed the story, let's start here with CNBC. This report came out last week. Wells Fargo tells customers it's shuttering all personal lines of credit. Of course, why would a bank do that? Must be something really bad to cause them to get rid of their credit lines. So let's see what they're up to. So they're cutting down all their personal credit lines. Everyone's getting a letter. And if you had one of these, you may have had a revolving amount of $300,000 to $100,000. And yes, so Wells Fargo says, quote, recently reviewed its product offerings and decided to discontinue offering personal and portfolio line of credit accounts and close all existing accounts. Ooh. And then move would let them focus on credit cards and personal loans. So why would Wells do this? Is this a leading indicator here of some stress in the banking system? Well, not really at all. Here's the truth. Let's take a look at this next paragraph here. Wells Fargo CEO Charles Scharf has been forced to make difficult decisions during the coronavirus pandemic, offloading, keyword offloading, assets and deposits and stepping back from some products because of limitations imposed by the Federal Reserve. In 2018, the Fed, under the leadership of former Fed Chair Janet Yellen, barred Wells Fargo from growing its balance sheet until it fixes compliance shortcomings revealed by the bank's fake account scandals. Now, as a Wells Fargo customer, I happen to know about the fake account scandal because, yes, I was probably part of that. I believe one of my accounts was from that. So I can tell you that what's really going on here is that Wells Fargo's in the penalty box. And we've talked about this before, that if the Fed will unleash Wells Fargo, they're going to come back in a big way and need to buy bonds. But in the meantime, what the Fed has done is limit how big Wells Fargo can get. And if you can only grow your balance sheet so much, and you're seeing a lot of cash coming in, perhaps due to all these stimulus checks, how do you limit the size of your balance sheet? Well, you stop lending. Now, I actually called Wells Fargo, again, as I mentioned, being a longtime customer of the bank. Mind you, that is not an endorsement in any way, shape, or form. I did call them to talk to them about this, and they said, well, yes, this is true, and this is happening right now. By the way, in the first quarter of next year, we're going to be reopening and offering home equity lines of credit. I didn't realize they weren't doing that at this time. So whatever reason, there's going to be a temporary shift out of personal line of credits and shifting over to home equity lines. I was told that in the past there was some concern by Wells about home values, but apparently now they're not as concerned. So think of it as they're just shifting the risk. Now, underneath their balance sheet, is there something going on with that we can't see, that maybe they can do more home equity lines and offload that risk? I don't know. But this entire headline is simply due to the Fed slapping Wells Fargo on the hand, and they have not released them from the penalty box. And we don't know when they're going to. There's been no timeline, no comment from the Fed, but it is up to the Fed to release Wells Fargo. So for those who made this out to be a big deal, it really is about as much of a non-issue as non-issues get. Now, there's some questions about what's going on at Citibank. Citibank is not one of the big, they are a big major bank, but they're not a big player in the consumer market here in the United States. So anything going on with them probably has to do with the fact that they're not a big player in the U.S. consumer space. Now, tomorrow we have the 30-year Treasury auction, but before that, the consumer price index is coming out. There's a lot of speculation. It's going to go even higher. And well, it could, but let's go through a walkthrough and see what could happen. I've got some really cool data from a buddy of ours to show you. So let's start out by going through the correlations, and let's chart the consumer price index here against the 10-year treasury in blue. And what you notice is the 10-year treasury yield has continued to fall since the 1980s and is headed lower. And when you see the consumer price index rise against falling yields, well, what it means is that yields are going, or that consumer prices are going to follow it lower. Here you can see yields heading down, consumer price falling. You can see it some other places. The whole notion, there's this belief in the marketplace, and I don't understand quite what it is that when consumer prices go up, well, you have to pay a higher borrowing cost. And yet for 40 years, we've seen higher prices, just the rate of those higher prices have been slower, and we've seen lower interest rates. So there's really no evidence that says, yes, higher consumer, if you spend more money on a good or service, you have to pay a higher interest cost. But what lower interest rates are telling you is that financial conditions are tightening, and ultimately higher consumer prices will be rejected because there isn't enough money to support them. So one thing you do see in this chart is the direction of treasury yields heading lower, suggesting that while the CPI can go higher, you can see it went higher here before it came crashing down, that higher prices will get rejected. Now let's take a look at crude oil, because there is a strong correlation between consumer prices and crude oil, because crude oil is in lots of different things. And you can see here that crude oil isn't really validating this big move higher in the year-over-year rate of change in consumer prices. But that maybe doesn't tell us the whole story about crude. So what I did is I put a chart together of the year-over-year rate of change in crude oil, and you can see just how big of a move there. But the year-over-year rate of change in crude oil is here, suggesting that the CPI is going to get rejected. You can see the year-over-year change in crude went up, CPI was going up, year-over-year in crude oil is going down, crude consumer price index headed lower, and you can see that nice relationship. You see it here, suggesting that perhaps we do get one more month of higher consumer prices. Maybe the peak is already in, but we're close what we're seeing here. How about we look at the Money Multiplier, which is the M2 money stock divided by the monetary base. And we can see the effects of tighter financial conditions, because when the Money Multiplier goes down, you tend to see consumer prices go down because financial conditions are tightening, and that means consumers cannot afford higher prices. You can see here consumer prices going up, the Money Multiplier going down, and what happens? Those higher prices get rejected. So the Money Multiplier is saying, it's been saying, look, this trend higher in the consumer price index is not going to last. How about we move on to the dollar, and you can see a pretty nice inverse relationship. Now, these are not perfectly inverse, but there is an inverse relationship here, just not perfect. And the dollar's trended up a little bit since it's low, putting downward pressure on the CPI here. So again, another view that's saying that, yes, perhaps we're looking at another month of higher prices. You can see here the dollar started to move up and the consumer price index went a little bit higher. But what the dollar is telling you is this move higher in consumer prices is near the end. So I called upon my buddy, Julian Battelle, and I probably got his last name wrong, and I apologize, Julian. And he's with Pickett Asset Management, and we've seen his charts before, and they're phenomenal. And I asked him, hey, can you run us a chart of the U.S. headline CPI percentage change year over year versus the ISM Manufacturing Prices Paid Index? And he came back and said the ISM Manufacturing Prices Paid Index has a 2-month lead on consumer prices, and I want you to think about why that makes sense. So prices paid in the factory come in at a high point, it gets to the consumer 2 months later. So that's pretty interesting that we're seeing that perhaps as the prices paid index looks to be peaking, is very high, that perhaps we are due to see a little bit higher move in the CPI. And I asked Julian, I said, well, what do you think about this? And he sent me another really cool chart. So you can see there's a really nice relationship here, and this makes a lot of sense. He said, well, he has a trend indicator, and I tried to get a little more information out of him on what was in there, and he said, well, it's proprietary based on his internal data, which we, of course, respect. And he shows, you can barely see the CPI right here. So he's predicting that the CPI year over year is going to get up to almost 6% before it comes crashing down. He didn't give me a timeline on that, but you can see it tells us we're within a couple months of a peak of a CPI. So what does that tell us for tomorrow's CPI report? Well, it tells us it's probably going to be a little bit higher, but the bond market doesn't care, because the bond market back in March, Treasury yields peaked, suggesting that whatever's going on here in the CPI is absolutely transitory. And if Julian's data is right, well, we're going to see that. All right, let's get into the economic data. And then we're going to talk about the hedge fund positioning, because yes, they're back shorting bonds. What are they up to? And let's head to Sunday night. Core machinery orders in Japan surging higher, 7.8%. That's a big number, but these things are super volatile. How about producer prices in Japan? Went from 0.8% to 0.6%. That is slightly disinflationary. And the year-over-year rate of change went from 5.1 to 5.0. So we're seeing a slowdown now in producer prices coming out of Japan. And how about we look into the Eurozone? How about we focus on Germany? Wholesale price index month over month surging 1.5%, taking it to a year-over-year plus 10.7% change. That is a huge surge in wholesale prices coming out of Germany. Let's move into the U.S. today. We had some auction data, and let's take a look at what's going on there. And we had the 3-year Treasury auction, met with decent demand. There were actually 4 auctions, and this was met with decent demand again, a little bit under its 6-month average on its bid to cover, but overall decent take. The 10-year Treasury auction was also received with decent demand, nothing spectacular, a little bit under its 6-month average. And why would that be? Well, again, you got the CPI report tomorrow. So, a lot of people think that there's this grand relationship between yields and consumer prices, where yields are going to go higher if consumer prices go higher. We looked at the chart, that there's absolutely no evidence of that at all. So, which suggests that the market is just doing what the market does, and that is trying to front run what it expects to happen. So even if the CPI goes up, the bond market is telling you it's no big deal. So let's go on and take a look at how hedge fund managers are positioned. And what we can see here in the 10-year Treasury, they reduced their shorts a little bit. And what they did do is they increased their shorts quite a bit on the 30-year. Now, if we look at a chart of the 30-year bond, we can go see where they actually increased their shorts. We're right in here. So these last, since the COT report is as of Tuesday. I think it's due to the holiday week lagged Wednesday, but you can see they were starting to increase their short positions right here. And we can look into the data, or into the price action. We can see there's a lot of shorting going on here, and you can see short all the way down, shorting in after hours right now as we are recording the show. So speculators are shorting this. They think that the higher consumer prices are going to lead to higher interest rates, but as we know, that's not true. And so they're continuing to build their shorts as they fight the Fed and the problem with the reverse repo, which we are planning to have a big chat about in an upcoming show. How about in the West Texas Intermediate futures down a little bit, still very, very long. S&P 500 increased their longs as they're betting on higher equity prices. Euro, you see they're reducing their long position on the euro. That should have downward pressure on gold, even though they increased their positions on gold. So that's a little bit odd. Lower euro should lead to higher dollar, lower gold prices. How about the Nasdaq? They're about net neutral on Nasdaq. Russell 2000 remain very short on, not very short, but rather short on small caps. And on the dollar, look at that, big move higher in the dollar as they're increasing their longs on the dollar. So that is an indication that speculators are changing their mind, which is odd because you think they would be long dollar and want to be long bonds. That doesn't make a lot of sense. Unchanged on the VIX. How about we go to our buddy Stefan at Skyway Asset Management, and he shows us here, what do we have? The non-commercial versus total futures positioning. So here you see the non-commercials increasing their short position as TLT is moving higher and looks to continue that rally. Total net positioning, he said, on the long side, this is looking at all positions from across everybody, is falling. And he tells me, based on his data, that's just telling us the beginning of a move higher is coming. He also sent us Citigroup's dollar pain index, showing just how how many people are short how relatively short the market is dollars, looking at all different currencies and different positionings. And he's saying everybody's super short the dollar. And of course, if you're bullish on the bond market, then you are also bullish on the dollar. So that's our show for today. We will be back on Wednesday. We'll have the CPI report. Perhaps we'll get into this reverse repo mess, because as I peel back the onion on this, it's way more serious than people think. And I believe it's actually an indication that quantitative easing is tightening financial conditions. Anyways, thanks for watching. Thanks for being fans. Thanks for supporting the show. And I will be back on Wednesday. Bye now. The content of this video provides educational information only. Is not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre personal capacity. Business expressed this video that do not reflect the Atlas Financial Advising or Steven Van Metre Financial.